our age demographic and can relate to the things that we're going through. So on this call, I don't know, I think we have some established business owners. I think we also have some new people that are coming into being a small business owner. So today's really meant to be informative, and there's some updates in Illinois that we wanted to bring to your attention. Whether you're an S Corp or an LLC, we want to talk about the year-end deductions, retirement considerations, payroll. And so with all that being said, we're going to hope to keep that to around 30 minutes and then turn it over to you ladies for Q&A. So at this point in time, I would be honored to kick it off and introduce Lauren, our CPA and our speaker of the day.
Thanks, Mel.
Yeah.
Hi, it's good to see everybody. Some names that I know and some that I don't. But as Mel said, we connected recently. We really hit it off. She specializes in women clients, and you know, as a woman in business, I can personally relate, and I know we have a lot of woman-owned business clients, and I thought that you all would also benefit from the introduction and advice that she has, as well as, you know, the tax topics that we'll cover today also. So there have been some changes, as Mel mentioned. The biggest one is this Illinois PTE, and I'm not sure if you as a sorry, okay. So Illinois PTE is the biggest change for this tax year that will provide some tax benefit. And as if you're current clients, we will obviously do this analysis. If it applies to you, we'll let you know to make sure we can take advantage of the tax benefits. If you're a prospective client or just somebody, you know, any woman in business, it's just good to know about these tax changes and deductions and savings to be aware. So I'm going to throw up a PowerPoint here so you guys can see the points of interest for the Illinois PTE as I talk about them. If I can figure out how to share screen. Okay. All right.
Looks good, Lauren. I can see it.
Yeah, you can see?
Yep.
All right. So like I said, Illinois PTE it's this new tax law. It was signed into effect late 2021. So a lot of people still haven't heard about it. 2022 was really the first year that CPAs and businesses are taking advantage of it because they kept releasing legislation. But anyway, so now in 2022, it's something that we want to make sure is on everyone's radar. And essentially what it is it's a workaround to the $10,000 cap on SALT, if you're familiar. At the personal level, if you itemize your deductions, that's taking mortgage interest, property taxes, donations. A lot of people ended up taking the standard deduction ever since the Tax Cuts and Jobs Act of 2019, because what they did was they maxed the taxes you paid personally at $10,000. So that's your property taxes and your state income taxes. And if we live in Illinois, most people's property taxes are easily the $10,000. So you're getting no benefit from any of the taxes, income taxes that you're paying to Illinois. So Illinois came up with this PTE law, and what it is it allows the business to pay for the personal income tax for the state of Illinois, and then take that as a business deduction.
Oh, that's pretty cool.
Yeah, and which, you know, we're all surprised that Illinois is doing anything beneficial for our taxes, but we'll take it. So I
have a question, Lauren. So does that mean that for 2022, you would still take your standard deduction, not itemize, but then take advantage of this from a business perspective?
Yeah, so most likely it's not going to affect you at your personal level.
Okay.
You will still take either the standard or the itemized, because either way, you're still capped personally at $10,000.
Okay.
But it's at the business level where you get to take that deduction that you would normally have gotten in the past on your personal return.
Okay, so again,
And
just to clarify, this
it-
benefits people that are homeowners.
Yeah, it benefits anybody really. I mean, if you live in Illinois, you're paying, state income tax withholding through your job,
Got it, got it,
right?
got it. Okay,
And
got it.
at 5%, yeah, that gets you easily to that 10,000 max with property taxes. So most people are limited by the SALT cap at the personal level. And so what this does is it gets around that, gets you still that additional deduction that was essentially taken away in 2019.
Okay, what does SALT
So
stand for?
it's state and local taxes. Good question. I forget, these are acronyms I use all day, but yeah, state and local income taxes.
That's okay. No, well, we have them in our industry, and I'm sure most of the women on this call have their own acronyms as well. All right, so state and local taxes.
Yeah.
Okay, so got it.
Yeah. And so, and it benefits different entities differently, which I'll show you an example of how that is. And then also because 2022, it is treated so the same at the personal level, right? If you pay your taxes, if you owe tax, the IRS and Illinois want you to pay it in ratably each quarter over the year to avoid penalties.
Right.
And so we all do that to avoid penalties, or we don't do it and, call it a cheap loan from the IRS, holding on to your money until April. So the same thing applies at the business level for this Illinois PTE. So the fact that you've not paid in your 2022 business tax throughout the year, there is going to be a little bit of a penalty on your 2022 tax return. But we've found through the different analysis and the returns that we've already done is that the tax savings for 2022 still outweigh the penalty. So you still come away with some with good tax savings. And then we also will set you up with 2023 quarterly payments through the business. So it's all going to be paid at the business level. It will be deducted at the business level. So to the extent that if you make quarterly estimated payments to Illinois personally in the past, you will not do that moving forward. It will be paid through the business and attached to the business EIN instead of your social security number.
Okay, that's interesting.
Yeah, and so this time next year when we do the same thing, you won't have that penalty. So your tax savings will be even greater. And then in the same tune, if, for example, in 2022, say you already paid all of your quarterly estimated payments. So you're not planning to owe Illinois any money when you file your taxes because you've already paid your taxes in on that business income. You can still do the PTE payment to get that federal tax deduction. And then to the extent that you overpaid, you'll get a refund of all of those payments on your personal return. So it is kind of like there's two cash outflows because you already paid it in through the year and now the business is going to make another payment in March, but you'll get one of those back and you get the tax savings from it. So again, kind of the same as the quarterly estimates. Moving forward, we would eliminate that so that way you can hold on to more of your cash and then there won't be a refund at the end of the year. You will have just paid in what you needed to ratably.
So Lauren, do we know if this new tax law is going into effect in perpetuity or just right now we know it's 2022 and 2023?
It's through 2026 right now.
Oh, okay.
Yeah. So we have a few years of this to take the tax benefits, which is great.
All right, fantastic. I mean, I'll take it. I don't know what Illinois is thinking, but I'll take it.
Yeah, right. We'll take it. Okay. So just as an example, or first I should go back to S Corp versus partnership differences. So as a partnership, so it's Form 1065 in Illinois, there's this deduction for what's called reasonable compensation. So again, if you're a current client of ours, or if you're a client, getting your taxes done elsewhere, typically that deduction is taken in Illinois only. And so what that does is it reduces your Illinois business income to zero. So you are not paying this 1.5% Illinois business tax. Great for partnerships, awesome. If you're an S corporation, you know that we don't have that deduction and you're paying that 1.5% every year. And that's just the cost of doing business, you know, difference of entities. There, you get the federal tax savings as an S corporation.
Right.
So the caveat with this Illinois PTE is that Illinois has said if you take that reasonable compensation deduction, which drives your income to zero, then you can't do the PTE. So you can choose essentially one or the other. And you'll see in the next example that I'll throw up here for a partnership is that the 1.5% Illinois tax ends up costing you more than the tax savings from the PTE would. So again, in all of our analysis, we've found that the Illinois PTE deduction really only benefits S corporations for the most part.
Okay.
And so as an example that's on the screen, if you are an S corporation, the tax savings, if your S corporation makes $100,000 for that year, the personal income tax rate in Illinois is 4.95%. So that is the PTE payment that you'll pay in from the business when we file the taxes. So you've got $100,000 of income, 4.95% of that is $4,950. So when the return's prepared, we'll give you a voucher that says, hey, you need to pay in this $4,950 for the Illinois income tax. But now you get to write that off on the business return. It's a deduction for $4,950. And of course,
Lauren, I have a real quick question. I mean,
yeah.
I get this notice from Illinois all the time, and I feel like mine says 3.5. Did that number go up?
4.95 is the personal income tax rate, flat rate, has been for years, but it could be maybe the 1.5% replacement tax for Illinois that you're talking about, the business tax.
Okay.
And so, and I didn't include that in this example, but you do still pay the 1.5% Illinois tax on the $100,000.
Okay.
So that doesn't
Again,
go
all
away.
the reasons why this is so complicated, not what I want to deal with as a business owner.
Yeah, right, exactly. We just tell you what to pay and you send it. So yeah, but again, in this instance, if you get that deduction for $4,950, if you are in 24% tax bracket personally, which is where all of your business income is taxed because it's a flow through entity,
right?
Then you get a 24% tax savings of that deduction, which comes out in this example to be $1,188.
Okay, I'll take it.
So yeah, it's you know, not a huge amount, but we'll take it. And certainly the higher that income number is, the higher those tax savings become. And also at lower levels, it's still beneficial. You know, cut that in half, $50,000, if that's your income, then your tax savings are going to be closer to $500. But like I said, there is a penalty as well. So in this example, if your tax savings are $1,188, maybe your penalty is $300. So your net tax savings are going to be a little bit lower than that. But again, it's still savings. And it's not that you're paying anything additional, right? It's not costing you anything to do this. It's just the, you know, making sure that it's captured and making the election and sending in the payment in March versus April, essentially. So I guess the time value of money for a month is the cost of it. But does that example make sense to everybody? Do you see how the tax savings comes in and how it varies with the income level? Good. All right. Yes. No one seems too confused yet. And then, so the other side of that would be the partnership example, which I had mentioned. So take the same assumptions, $100,000 of income, but every year you've taken this reasonable compensation deduction. So you've never paid that 1.5% business tax to Illinois. You might not have even known that that was a thing. But say this year you want to do the PTE because everyone's talking about it, Lauren's telling you it's a great idea. And now all of a sudden you do have to pay that 1.5%. So if you look at the savings and cost breakout, you'll see again, the payment stays the same, the 4.95%. The federal tax deduction is the same. your tax savings are the same of 1,188, but now you're paying this 1.5% Illinois business tax of $1,500, which you weren't paying before. So it's kind of an unfair advantage, obviously, and it's case-by-case basis. Not everybody takes the reasonable compensation deduction. So if you're a partnership that's already paying this 1.5% Illinois business tax for whatever reason, then you would benefit from the Illinois PTE because you're already paying that $1,500, so you might as well also do the PTE and get the tax savings.
And so you said that obviously an accountant or a CPA firm will be able to do this analysis to determine which one makes more sense.
Yes. Sorry, can you hear me? I think I just lost everyone.
No, I can hear you just a little
I can hear
louder.
you. You're coming in.
Okay.
So a couple people in the chat box wanted to know how does this affect like an LLC?
Sorry.
There you go. We can hear you now, Lauren.
All right, I'm back. Sorry about that. What was your question, Mel?
An LLC, how does this PTE affect an LLC, if at all?
Single member LLC, it does not affect it at all. There's not an option to elect PTE status as a single member LLC.
Okay, so it doesn't pertain.
Yeah.
Okay, that's interesting.
Because there's no separate entity.
Did they explain why they wouldn't do it that way? Is it because of just how?
Well, there's no separate entity. As a single member LLC, all of your income and expenses are reported on your personal tax return.
So you're one and the same person, basically.
Yes, exactly. It's under your Social Security or your EIN, which is a single member LLC is what the IRS calls a disregarded entity. So,
okay.
And that might play into also, you know, the conversation that we're constantly having with clients who are business owners, which is, should I be an S Corp or should I be a partnership? You know, if you are a single member LLC, all of that income is subject to self-employment tax, and electing, excuse me, electing to be taxed as an S corporation can save you quite a bit in self-employment tax, that FICA tax of 7.65%. And we typically, within our firm, the threshold that we usually look at for that is net income of $60,000. That's when the tax savings start to outweigh the additional cost of having that S corporation, you know, because the additional costs are a separate tax return. You have to pay a payroll service to run payroll. You've got the 1.5% Illinois business tax. So if you are a single member LLC making $60,000 or more, it might be time to talk to your accountant about, should I be an S Corp, or is there a reason that I'm an LLC, or should be maybe a partnership, which is still taxed the same as a single member LLC, but it would file its own separate tax return and would be a separate entity essentially.
Well, and I think you bring up a really good point, depending on when people establish their business. And I can say that I was one of these people that back in the day, the state of Illinois to establish an S Corp was significantly cheaper than establishing an LLC. And for some of you in the last 5 years that have established businesses, they've made that cost basically even. And so that all being said, I went with an S Corp because I was like, well, it's cheaper and I'm broke and blah, blah, blah. But when you really do look at the benefits of an S Corp versus an LLC, and I didn't realize you had a number in mind. I love that you put that out there, that like 60 grand is that kind of that number where you want to reevaluate. I mean, my good friend Tiffany and I were talking about this last night. There's major benefits to both sides of the, you know, the legal entity that you pick.
Oh yeah, absolutely.
But there's also negatives that go with it too. So you really need to be aware of what you're giving up and what you're taking at the same time. So that's why I think working with a professional, the tax professional, is really important. So thank you for sharing that with us, Lauren.
Yeah, and kind of in the same vein, part of the things that you need to weigh with being an S corporation is that payroll piece, which
stinks, by the way.
which stinks, right? But at least you're only paying that 15.3% on whatever's on your W-2, right? That's how you get the tax savings.
You do get a big tax savings with an S corp. Yeah, you do.
Yep. And so that's another thing to keep in mind for this tax planning is that, you know, as a business owner, things fluctuate. So if you have a down year one year, you might think, hey, I'm going to skip payroll. I'm going to do 0 payroll for 2022 because, you know, I broke even through the business. Something to consider is still running a very small payroll because that keeps your SUTA cost down, your state unemployment rate. So it takes, you know, the first year of having payroll through Illinois, the state unemployment rate is high. I think it's like almost 4% this year. And over time, as you consistently have payroll with no unemployment claims, that rate drops like 1% or 0.5%. But if you ever stop payroll and then start again, you jump back up and you have to work your way down. So to the extent that even if you have a down year, run a $500 payroll for yourself. So that way you keep that SUTA rate down. And just, you know, just another small tax savings, but it all adds up and it's, you know, not hard to do. If you're running payroll every year, all the systems in place, throw something small on there, pay in the 15.3% on a minimal payroll. And that's going to easily outweigh the savings of having to pay high unemployment for the next 4 years again.
That's good advice. I had no idea about that.
Yeah,
Lauren,
that's
can I ask you
Yeah.
a question as a new business owner? When you say run payroll, you're saying you can pay yourself. You don't have to pay someone else, just take it. Correct?
Yeah. Payroll to yourself as the owner.
Okay, I have no people, that's why.
Yeah,
That's a
and
great
most of our
question.
clients,
That's a great question because I don't have any
Yeah.
people either, but somehow I still have to pay for my business and I pay myself as an employee.
Right, okay, thank
Yeah.
you.
Yep.
That's a great question. That's a great question.
So those were just some thoughts. You know, we're always trying to think of ways to keep taxes down, keep more money in you know, in our pocket as the one doing the work, and so the next thing is other just in general year-end deductions to consider. Again, your CPA will help you with this. If it looks like something's missing on your return, they'll let you know. Some of the big year-end ones, some deductions that maybe a business owner might forget about because they're paid personally, but are actually business expenses would be your cell phone and your home internet. Because you can argue that you can't run your business without your phone or internet.
Right.
And a lot of those things might be rolled into some home plan. So maybe it's not paid out of your business. So maybe that's not picked up on the business financials that you send over to us. So that's just something to keep in mind. Any other year-end things, if you're thinking about buying a new car in the next couple of years, maybe buy it in December instead of January and get that write-off, you know, in the current tax year, if you expect that you're having a bigger year, you know, I know that year-end for 2022 is come and gone.
Wait a minute, Lauren,
But
are
for
you saying that I can buy a car and write it off?
Yeah, part of it. Yeah. So if you buy a car, if you use your car at least 50% for business, then whatever that business percentage is, you can write off the value of the car over 5 years.
Really? I did not
Yeah,
know
so the
that. I just
first
knew
year,
you
it's
could
a
take
big
like the
deduction.
mileage, but I didn't know you could write off the car.
Yeah. So without having, and I love talking about this, so I won't bore you guys, but you can do either mileage or actual business expenses. If you choose to do actual, then you get that big depreciation write-off in year one. The limit for 2022 was like the max you could get was $19,000 in year one, but that's reduced by your business percentage, right? So if you only drive your car 60% for business, then you get 60% of 19,000. But then the rest of the value of the vehicle is spread over the next 4 years, and you get that deduction each of those years. So in that instance, actual car expenses are much more beneficial, but the trick is you have to stay you have to keep using actual until you get rid of that car. So if you hold on to that car for 10 years, you know, years 6 to 10, you have very little auto expense write-off. I mean, you'll have, you know, gas and repairs, but that depreciation, which gives you that big benefit in the early years, is gone. So you can't say in year 6, hey, I'm going to switch back to mileage because that's giving me a bigger benefit. So just something to keep in mind if you do buy a new car and decide to do actual, versus if you're driving consistently for work, mileage might be the better option for you over the long term.
It's interesting. I didn't know about that. One thing that always seems to come up for me, and I'd love for you to touch on it briefly, is writing off office space. So, you know, as a small business owner, you know, I think it was Debbie that brought up the question, you know, it's her and herself, and it's me and myself. And I think a lot of people here on the call do not have employees and they work from home. And you read these articles that are like, you can write off your home.
Yes.
It's like, but not really.
Yeah. And same thing. I mean, it is a good write-off, right? If you're working from home, the rule is if you don't have an office space elsewhere, then you can write off your home office. And I do think that's the case for, you know, probably 80% of our business clients is they're working at home. And so similar to the car, it's the percentage that you get to write off. So if your office is 300 square feet out of a 3,000 square foot home, then you can write off 10% of your home expenses. So 10% of mortgage interest and property taxes, or 10% of rent. Also utilities, assessments, repairs, anything that's done to the home, you can take 10% of. If you do things directly for your office, so say you repainted your home office or you refurnished it, those those are 100% write-off because those are 100% directly related to the office and not the overall home. And also similar to the car is there is the option to do a standard home office deduction, which is you just automatically get $5 per square foot up to $1,500 deduction. So
do you actually
again,
have to have a
typically
room
doing the
dedicated?
actual-
Because like for me, it's my kitchen table.
The rule is that yes, it has to be 100% dedicated. Shared spaces don't count.
Got it.
Not almost everybody's, but oftentimes people don't have one dedicated space. You know, they're working in the living room, they're working at the kitchen table, they're working in a spare bedroom. So really it's, you know, it's not something that, like if the IRS were to come back and audit and say, prove this is a home office, we could most likely make that argument, you know, and we feel comfortable taking that stance as a CPA firm of, listen, they're working at home, and especially in this day and age, COVID, remote work, everybody's working at home. So while it should be a dedicated space, yes, as long as we're not getting crazy, I think it's arguable, right? You can't say, well, I work all over my house, so I'm writing off 100% of mortgage interest or rent.
Well, I mean,
you know, that's where
do.
things get a little dicey, but as long as it's, you know, a reasonable, arguable position, you know, we're happy to take it. And it is you know, that is in fact what's happening. So.
Can I ask the other side of that question, which is if it's a dedicated space, but you don't only use it for your side, like I have a full-time job and I have a side business and I use it for both.
That's a good question, Diane.
But it is dedicated to work. So
yeah,
how does that work?
So I would say in your case that I would still take that full room as your office. I mean, the fact that you're using it for your full-time job, fine. You're not writing it off twice. You're not taking a home office deduction against your wages because you can't anymore. And then also taking a home office for your side business. So I think, again, you know, if it came down to it, the IRS would be like, yeah, that makes sense. She's using that office for her side work, which is what we're using as the deduction.
Awesome. Thank you.
Lauren, I have a question. And so this is for the write-off is on your personal return, not your business return, right?
Yes. Yep.
So then here's my other, because I think, and I sound silly for not knowing 100%, but my husband and I both use the home office.
Mm-hmm.
So we can't both write it off, obviously, right? It's just because we do a joint tax return. So it's just one of us
You can each have home offices. So if you said, I'm working in this spare bedroom and my husband's working in this office, you guys could each take that home office. But if you're both working in the same room, then we would either report it as one home office for that full amount, or we'd split it 50-50.
But if it's a
and-
joint return, I guess it doesn't really matter, right? Because this is on our
Right.
personal versus my business return. Okay.
Yep,
That's
exactly.
a great question. That's a great question. I would have
Yeah,
thought about
that is a good
And
point.
that's like a legit thing in today's day and age, right? So
Right.
Thank
that's
you.
a really good
So
question.
yeah, there's so many things to think about and ways to make sure you're taking the most beneficial stance on these things. But those are the big things that I wanted to touch on. And then obviously, I think the biggest thing that we talk about and focus on at year-end planning and filing is retirement. That's one very important deduction, we think, just in life. It's also a great tax deduction. And that's something that can still be managed up until the time you file, depending on the type of plan.
Mhm.
So right now, as we're talking about year-end deductions and filing, that's where I would direct you to MEL or to, whoever you're talking to about retirement planning, because you want to think about the plan that benefits you the most based on your type of entity and also just your overall portfolio. So I'll let Mel take it from here with the different types of plans and which ones can still be funded and, her takes on those.
Yeah, thank you, Lauren. I think the biggest takeaway that I had is that from 2022 to 2023, the amount of money that you can put away has increased. So the IRS has raised the limits. Obviously when you're first starting out, you may not be making a whole lot of money, but as your business grows, this is one of the best ways. I mean, to pay yourself first. I'm a big proponent of that, right? We all want to retire at some point. I mean, I think if you're a small business owner, there's a good chance that your thought is that you probably work past age 65 or 67 if you're still passionate and you still have your brains with you. But just a real quick thing, so as a small business owner, if you have a 401k, it's increased its it's increased its limit for 2023 by $2,000. Again, that would be for starting in 2023. You want to increase your monthly contributions to that. Your SEP IRA is still at 25% of compensation. Lauren, correct me if I'm wrong.
Yep.
But that's $66,000, up to $66,000 that you can sock away and avoid paying to the IRS.
And I do want to say on that note, again, that's something to take into consideration on the entity type. If you're doing an S Corp, then typically we try to do a small W-2 to save on those payroll taxes, but then your SEP contribution is limited to 25% of that.
Right.
So if you're somebody who is really trying to maximize retirement, then S Corp might not be the way to go for you because you're going to have this giant W-2 in order to put away 25% of that to max out your limit. So in that instance, it might be more beneficial to stay a single member LLC or partnership.
Well, and that's that's really good to point out. But the other thing is, if you can't hit that number, which to your point, I didn't hit, there is this simple IRA that you can put into like 15,500. Another thing we didn't talk about is that you do also have to take into consideration for some of these plans, if you do have employees, you are required to put money away for them too. An additional business expense that you have to take into consideration. If you're a brand new business owner, I'm still a big fan, and Lauren, I'd love your opinion of a straight up traditional IRA. You can put, up to $7,000 into that bad boy.
Yeah, definitely. I mean, get something put away.
If you're just starting out and you need somewhere to go, like that's a great place to start.
Yeah, and a Roth is always a great option. All this, of course, depends on your income limit, whether you can fund a Roth. And, and if you're over that income limit, another great alternative is to do a backdoor Roth conversion, which Mel's super familiar with. And that's a way to get money into a Roth, even if you're over that income limit. And, we can touch more on that, but essentially you make just a contribution to your traditional IRA. It's non-deductible because your income is too high. And then you essentially convert it and roll it over into a Roth IRA. So it's kind of an interesting workaround, and we're seeing that more and more from our clients of people who are doing this. But there are different stipulations I'm not exactly familiar with, and that would be Mel's, expertise. But I think it's if you already have an outstanding rollover IRA, then you're disqualified, or it limits the amount. So again, so many caveats around all of these things, and that's why
many things,
it's
so many
important to
things.
have a team who knows the ins and outs of things like this. But yes, to your point, that's a great place to start. If you needed to get some money in retirement, put it in a traditional or a Roth IRA. And then once your business grows, you have more money, then let's talk about a step or a simple.
I was going to say, you know what, every year I think you really need to talk to your CPA about what's the best thing to fund, because I have a client right now. We started with a SEP IRA, and now we've just opened a solo 401k. So for those of you that aren't familiar with that, there is the ability to open an individual 401k that's just for you. The only other person I believe that can be on that account is your spouse, if he works for you or she works for you. So depending on what the accountant says or the CPA, it all depends on which one might give you the bigger bang for your buck as far as retirement savings and tax savings. And I can switch every year. And I can switch every year, right? So
yeah. I had a client that just passed in 2022. Now we're doing the planning, we're doing the taxes, and every year she's maxed out her SEP. This year we want to do the same thing, and she was like, "Oh wait, I have an employee who's eligible this year," and that changes everything, right? Because do you want to put away an extra $7,000 for your employee just to max out yours? Maybe, maybe not. And so it's finding the balance there. Once you have other employees, is that okay? Maybe we do a simple, or maybe it's a solo 401k. And I know that there are different costs and fees to each type of plan. And again, that's something that your financial advisor will help you with. Maybe a solo 401k isn't great for somebody starting out who doesn't have the extra money for the fees and also isn't going to max it out. Again, in that instance, it's like just do an IRA until you get to the point where you are able to want to put more money away into retirement.
Yeah. I think the takeaway here, Lauren, is that you need to have a dedicated financial planner and CPA working together to make sure that you are maximizing your savings and your tax reductions.
Yeah, I mean, we might be biased, but I agree, obviously. And if it's not us, these are go back to who your advisors are, and present these things like, hey, I heard about this. Is this what I should be doing? And why haven't I? Whatever that is, but it's certainly a huge benefit to have your financial team and your accounting team plugged in and connected. So it's a two-way street of, hey, did you think of this? This is going to be better for their taxes. And maybe they're saying, we don't really care about the tax savings because we need to maximize their investment portfolio this way. There's give and take on each end. So it's not, you don't always want to just do what's best for taxes. You want to do at the end of the day, what's best for you first and foremost in your overall retirement and investment savings and portfolios.
Yeah, I mean, obviously I totally agree with you. And the one thing I would say also is that you should make a point of talking to your financial people in early December, because there's some deductions and things that you need to decide before the tax year is over, which for calendar year is December 31st. As a business, there's other things that roll into the next calendar year. But I do think it's really important to have that year-end tax planning moment in early December to determine if there's anything you can kind of tackle and reduce and save then. And then again, have that conversation early at the beginning of the year too.
And actually, that's a good point, because so if somebody, again, I'm going to use this client that I'm thinking of, she had the steps set up. We didn't realize that it was not going to be a great fit for 2022 until now. And it's almost too late, because some of the plans you do have to have in place by December 31st.
Mm-hmm.
And so we told her, get this new plan set up for 2023. But I think some of the plans have to be set up by like March or April. Is that right?
Yeah, I mean, so that's what I mean. There's deadlines for everything. And so I do think it's really important. And hey, ladies, let's be even more, excited about the fact that you made so much money this year that you finally qualify for a charitable deduction. Well, you have to do that by December 31st. right? And you need your financial people to look at that and say, okay, you've maxed out your retirement accounts, you've taken all the PTE, you've done all the deductions, year-end deductions, and you're like, I'm still owing money. And again, there's a lot of the cutoffs that happen at December 31st. So I think it's really important to also have that conversation with your people before the end of the year.
Yeah.
So.
I agree. So I think
Okay, well, that was everything we had on our agenda. I mean, at this point, I think we're going to open it up to Q&A, but we wanted you all to know that if anybody on the call wants a 30-minute complimentary consult with either of us, we'd be honored to do that. But at this point, if we have questions, we'd love to open it to the people that are listening in.